In this video, we're going to talk about what happens when the Federal Reserve starts printing money again. This is not a prediction based on guesswork. It is based on data, historical patterns, and what the Federal Reserve has already signaled. When the Fed begins creating trillions of new dollars, the impact will reach far beyond Wall Street. It will affect every homeowner, every renter, and every person trying to buy a house in America. The question is simple. What happens to home prices when the Fed opens the floodgates again? Let's start with where we are right now. Over the past 12 months, the housing market in the United States has split into two very different realities. In some regions, home prices are clearly falling. In others, they continue to climb. The biggest increases are concentrated in the Midwest and the Northeast. Cities like Chicago, Cincinnati, and parts of New York State are still rising. Meanwhile, much of the South and West, including states like Florida and California, are softening. If you look at the national average, home prices are up about 1.7% over the past year. But that average hides big differences between markets. If prices in your city are down 10%, you might think the housing market is crashing. Somewhere else, they are up more than 10%, and that evens out the national picture. What happens next will depend on interest rates, inflation, and the actions of the Federal Reserve. Mortgage rates have been one of the biggest stories of the last few years. After hitting almost 8% in late 2023, the average 30-year fixed rate has now fallen to about 6%. That is still far from the record low levels of the pandemic years, when borrowers locked in rates around 3%, but it is a major improvement for anyone trying to buy today. The question everyone is asking is how much lower rates can go and why they are falling at all. The reason is that the Federal Reserve has been cutting interest rates. Inflation is still elevated, but it is not as severe as it was 2 or 3 years ago. When the Fed cuts its policy rate, it affects the cost of short-term borrowing. Mortgage rates, however, move more closely with the yield on the 10-year Treasury. When investors expect slower growth or more easing from the Fed, the yield on that bond tends to fall, and that drags mortgage rates down with it. But here is where things get more interesting. Cutting interest rates is only one tool the Federal Reserve can use. The more powerful one is what economists call quantitative easing. This is when the Fed starts creating money electronically to buy bonds and mortgage-backed securities. It is, in plain language, money printing. Each round of easing in the past has been larger than the one before it. Each time, the Fed has needed to inject more liquidity into the system to keep credit markets and the banking system stable. When will that start again? Probably when something breaks. It could be a banking issue, a problem in commercial real estate, or a sharp fall in the stock market. When that moment comes, the Federal Reserve will respond by expanding its balance sheet again. That means trillions of new dollars will enter the system. When that happens, mortgage rates will likely fall even further, at least for a short time. That creates what some analysts call the opportunity window. It is a brief period when borrowing becomes cheaper before inflation catches up. This window might last a few months. During that time, refinancing or locking in a mortgage rate could make a major difference in long-term costs. But once the new money circulates through the economy, prices begin to rise. Inflation follows, and when that happens, interest rates start climbing again. This is the pattern that has repeated again and again. Money printing leads to lower rates and asset price inflation. Then inflation rises, bond yields move higher, and borrowing costs climb again. The only question is how long the next cycle will take to unfold. If you already have a mortgage rate near 3%, there is nothing you need to do. You are holding one of the most valuable financial positions in today's economy. But for those who bought recently with rates near 6 or 7%, the next easing cycle might be the one chance to refinance lower before inflation returns. Now let's connect this back to home prices. When the Federal Reserve increases the money supply, it does not just lift the stock market. It also raises the value of tangible assets like real estate. More dollars in circulation mean higher nominal prices for nearly everything. Food, utilities, and especially housing all move higher. This is why the argument that home prices cannot keep rising because affordability is poor does not hold up. Look at California or New York City. These are among the least affordable housing markets in the world, yet prices continue to rise over the long term. When there is more money chasing the same number of homes, values go up even if fewer people can buy them. So who ends up owning those homes? Increasingly, the answer is large institutional investors. Companies like BlackRock, Blackstone, and major real estate funds have been buying residential property for years. When liquidity floods the financial system, these firms are the first to gain access to cheap capital. They can buy entire neighborhoods, while ordinary buyers struggle to qualify for a single mortgage. Meanwhile, another trend is quietly building. Foreclosure activity has been ticking up. It is not yet alarming, but the direction is clear. Delinquencies are rising, and more homeowners are falling behind on payments. Still, the numbers are nowhere near what they were during the 2008 crisis. In fact, the current level of foreclosures is lower than in 2005. If you are waiting for a massive wave of foreclosures to crash the market, you may be waiting for years. In the last cycle, foreclosures peaked around 2010, but home prices did not bottom until 2012. That was about 8 years after the first warning signs appeared. Even then, prices after the recovery climbed far beyond their previous highs. The point is that time is not on the side of those waiting for the perfect moment to buy. By the time a true housing correction appears, the next wave of money printing will already have inflated prices again. If you can afford to buy a home now, doing so might be one of the best long-term protections against inflation. Buying a home is not about getting rich quickly. It is about owning something real in a system where the value of money is constantly changing. People sometimes argue that buying is a loss because of property taxes and maintenance costs. What they forget is that when those costs rise, landlords pass them straight to renters. Owning gives you stability and protection from those increases. A friend once told me that during the pandemic, his landlord raised the rent by 40% when the lease expired. They said that was simply the new market rate and that other renters were ready to take the unit if he refused. That is the reality of renting in an inflationary environment. Owning gives you control. The Federal Reserve will print trillions of new dollars again. That is how the system has operated for decades. Each cycle requires more money to maintain growth, and each cycle makes assets more expensive. The people who own those assets gain wealth on paper while the cost of living rises for everyone else. So when the next round of easing begins, pay attention. Mortgage rates will drop, inflation will follow, and home prices will climb again. The question is whether you will be in a position to benefit from it or be left behind as costs rise. Thank you for watching. Let me know in the comments what you think will happen when the Fed begins printing again. Do you think home prices will keep climbing, or will inflation finally force a correction? Remember to subscribe for more videos like this and join the discussion below.